So, we're really delighted to have Dan Sheridan here with us. And we've already put the topic in the announcement, so I'll let him give his own introduction. And very welcome. I've got the recording going. Welcome, Dan.
Oh, thanks. Thanks a lot, Don. I appreciate it. And Tom already said hello to Tim. But welcome, everybody. And glad to be here in these unusual times, right? It would be nice to actually be in Durham with you. And I still remember going after the last time I spoke there. Don, I'm not sure what the restaurant was across the street. They had good food, whatever it was.
Cameron Bar and Grill.
Oh, is that what it is? Okay, all right. It was good stuff. Would love to get out there again. But yeah, it's a very unusual market we're in, and but it's a good market, good for, I think, learning, good to have something different after 7 or 8 years of a little bit of bullish market. And so hopefully tonight we're just going to talk strategies and just kind of share what we've been doing in the Sheridan community the last 2-3 months. And any questions or thoughts, just we can go back and forth, and hopefully we can be a little bit of a help in as we all try to navigate through a very unusual market, not an easy market, but again, I'm not a pilot. Tom and Tim are, but I would imagine if you fly through turbulence a lot, you kind of get used to it. I don't think being a passenger in an airplane, I ever get used to it, but you always talk to the pilots and they're like, that was nothing. Well, I think the more you're in this market, you get a little bit more used to it, as long as we're not dropping 5-6% a day. But I have 3 best strategies in this volatile market. And these are just, I don't know if best is the right word, but three probably of the better ones that people have used for making a few bucks the last 3 months. And then I just added a couple because I had some extra time and I was thinking about it and added a couple. So I'm going to talk about 5 ratio call back spread, ratio call fly, iron condor, calendar, long diagonal. And 3 months ago, were we even considering a back spread, or 2 months? No. Were we doing ratio call flies like I'm talking about them tonight? No. Were we doing a lot of iron condors? No. Calendars, yes. Long diagonals, no. So it just shows the market a lot of times dictates what strategies we may do. And so really only one of these 5 we were doing regularly before everything hit here with the coronavirus thing. And then 4 have been a result of either the higher volatility levels or the daily 2% moves in the market, SPX. So let's jump in. So maybe to start with a 30,000 feet up in the airplane. See, every analogy now, every bad analogy tonight is going to be airplane. It'll be Tom's fault that
we got you going, Dan.
I know he's got me going. He's got me going. Not that I need a much help to get into my bad analogies, but here we go. So let's just start here. We'll just start kind of a big perspective, and then we'll get into some strategies. Let me just hit this here. So as you see here, this, whoops, did I hit something? You guys can see this, right? Let's see. I'm just going to annotate. I'm just trying to get the annotator. I don't know why it's, usually I just hit the annotate pencil and then it, why isn't it annotate? No, 1 second. Give me 1 more second. If not, see, I use Zoom, and usually when I just touch that annotate stick, then I can start drawing. Oh, here it is. Okay, thank you. So this is a 6-month price chart in SPX. And if you look here, this is basically what the SPX was doing before the Corona came. Agree? And so pretty range-bound market. The environment was probably characterized, I'm going by memory, maybe 12 to 17 in VIX. And so, but that's not unlike the volatility environment for the last 6, 7 years, right? I mean, we'd have some occasional 4% downward moves. We had one correction in October, November, December 2018. But other than that, relatively small down moves and just this uptrending low vol environment. So, in this environment, when it was 12 to 17, we were doing a lot of long Vega back spreads and stuff, different type long Vega stuff when we were 12 or 13 or 14, and maybe to 15 to 17, iron condors, different types of butterflies, different things. And that was it. Now, as we're coming to I'll call this Niagara Falls, as we make this steep drop here, but did we know what was going to happen here? No. Did anybody know? No. I mean, I think everybody thought the same thing. We're up 30% in the SPX last year. We're due to go down, but you could have said that 3 years ago, right? And sold into it and sold into it and sold into it and sold into it. So, I've always thought, and we always look in our community more, hey, trade what the market gives you. You keep trading it until it's not there anymore. And we basically look at some different indicators, and a couple of them are, we continued to do this, right? As we're going here, just to give you another example, during this period, we're basically looking, I kind of break down things into the options world portfolio into 3 categories: long portfolio, income spec, and then maybe cash. And going into this period here, we were probably, just again, giving a quick 30,000 feet up, and then we'll get into strategies. And just contrasting this, I just want to put here December 2018, because that's when the last correction was before this one. You could see me right there, can't you? I wrote outside the slide. Can you guys see that?
Yeah, we can see fine.
Okay. So long portfolio to me are strategies that are neutral to bullish, like the view of an investor. And it's funny, I was reading somewhere a couple of weeks ago, I think it was Graham. Isn't he the guy who was Warren Buffett's mentor, who wrote that book years and years and years ago? Well, he kind of broke down types of investors into 2 of them. I think he called one investors, and I call it long portfolio, same thing. And that's more neutral or bullish. I like Zoom over the next 4 years. I like the market over the next 6 years. Kind of like how people view in their retirement. I like Apple over the next 6 years. And that might cause you to put on strategies like covered right, cash secured put credit spreads on an intentional basis every month, right? And you might allocate into that portfolio. And as of December 2018, when we were down 20, 25%, if you like stuff long-term, you like it 20% lower. So at that point, and if you just take, 100K portfolio or whatever your number is, we were maybe 60% in the long portfolio. Now, in the long portfolio, right as we were getting to the end of Niagara Falls here, before the Corona thing, we were about 20%. Just because the market was very high, and we wanted to cut our long delta exposure in that part of the portfolio. Income portfolio in the correction, and I'll get to that in a second, in December of 2018, we were 20% because there was no range. Things were getting killed. Before this Niagara Falls thing here, as I call it, we were 50%. Because as you can see, beautiful range, income trading, which would be in this part of the portfolio. I look at iron condors, calendars, double diagonals, and different types of butterfly trades. And so we're 50%. Spec, I'll just throw that at 10%. I'm not really much good at spec stuff anyways. 10%, and that would be 80-20, and then maybe 10% or 20% cash. 80-90, this would be 10% cash. That gives you an idea. Again, long portfolio view of an investor. So I'd be doing covered rights or that type of strategy, neutral to bullish every single week or month. Income is more range-bound trades based on probabilities and decay, and spec is, hey, I have an opinion. Right? I have an opinion Apple's going to go up in 2 weeks. I'll do something, right? So that's kind of your big portfolio. And then here in Sheridan mentoring, this would be more Jay Bailey who works with me. He's good with more intricate numbers, but we just basic stuff, right? And I'm sure a lot of you have more sophisticated stuff, but we just, we continue doing the things that we've been doing and just saying, until VIX hit 18 and the ATR, we use an 8-day Wilders, whatever it's called, on Thinkorswim, when that hit 27 in SPX, which it did here on, I think, Feb 19th or 20. Feb 19th, I think, because I was in California doing a seminar. And at that point, we pulled to the sidelines as far as the income part of the portfolio. And really, until once VIX hits 18 and ATR hits 27, we just kind of stay out of the income part, and we won't enter any more long portfolio till we kind of get some type of a range. And as you can see, that first 30% down, there wasn't any stinking range. So we didn't really come in for the income trades till we get in this area. So we started to get some type of range that the world wasn't going to end. So anyways, that's kind of a big picture thing. So that's, as far as avoiding a lot of this with iron condors and calendars, we just weren't in. And as far as people that were in, the stuff that we're in, we're heavily recommending just for any adjustments by puts. And that was fine for the stuff you had on. So that's kind of how we navigated. And then once we've kind of got a bit of the thing we were doing a lot in this period were back spreads, which I'll talk about in a second. And we could still do them, even though the market's calmed down some. And then, and ratio call flies. And then as we've started to calm down a bit, calendars, iron condors, and long diagonals. So we'll kind of work through that. And the other thing I want to point out is, again, as much as we want to say we've lived, and I think it's tough for all of us, right? We're used to, it's like for the last 8 years, we've lived in Huntington Beach, California, all of us, right? We're used to this weather, beautiful weather, ocean. And then for 3 months, we moved to Chicago in the winter. We're like, what the heck? And for 8 years or whatever it was, we're used to this uptrending market, no Rodney Dangerfield attitude towards the downside, right? No respect for the downside, buy every 3 to 4% dip in the market. And this is unique, right? And this is finally something different. So the way I'm looking at volatility and strategies now is, again, this is our reality. This is our reality right now, right? And if you look at, I think it would be this right here, as I'm circling, the SPX the last 2 weeks is 27.27 to 28.79. So we've got a pretty tight range, right? The expected range over 2 weeks is a little over 200 points. The VIX last 2 weeks is 37 to 45. My range for has been for weeks now, but where I think, going the next 2 weeks and how I'm kind of deciding which strategies, I'm using a range of 35 to 50, right? Really, the lowest we've been is 37 in the last few weeks, I think last Thursday. And now we're back up a bit. So this helps. So it's kind of weird. In 3 months ago, I would do calendars only at like 12 or 13 volatility. Now I'm doing calendars at 35 to 37 volatility. It's, as they would say, it's madness, but that's the range. And until there's something gives in this whole coronavirus and stuff like that, or until something changes in the market, that's the range, right? I mean, as far as what we're kind of trading off of. And then as we're doing trades, the expected range for the next, today's what, Thursday? The expected range over the next week's about 116 points. And again, expected range is just a standard deviation. So now, any questions on the big picture or anything from this end of it before we jump into strategies or anything on anything? And the big picture before we jump into strategies and kind of work on that for a little bit?
Does anyone have any questions for Dan on that part?
Or comments or if they've seen anything, or again, this is two-way. If anybody has anything, as they say, yeah.
You said the expected next week's range, you said you just pulled that from a standard deviation?
I mean, you could calculate it, but I was just more taking that from Thinkorswim. So if you look at what's today, today's the 23rd. If you look at the 30th expiration in SPX, you know how they give you that expected range?
Oh, no, I don't use Thinkorswim, so I'm not
Okay.
familiar with that. But
it's just the same thing.
Yeah, or you could just calculate it if you just take the underlying, which is what? Underlying 2797, we'll get close to that, times, let's say take a VIX level of, VIX is 41, so times 0.41, times, and if we want a 7-day standard deviation, 7 divided by 365.25 equals square root, with E times 0.13. So if we take 2797 times 0.41 times 0.13, you get this gets, with a 41, that gets 149 if I did it right. So if Thinkorswim might have had, did I do that right? Let me just see if I did that right. 41, 2797.
well, you used the VIX, right? But
Yes.
The VIX is the more or less the 30-day expected, right? So
Yeah.
and you said expected next week. So maybe that's the thing.
Maybe Thinkorswim's using a much smaller, let me just see if they use, let me just see here one second.
I think the proxy might be the at the money implied volatility for the 1 week option expiring in 1 week or so.
So so whatever the 7, I didn't look at the 7-day there. I don't know if anybody has that there, but they're using probably a smaller, but that's all you have to do is just put in, usually, like you said, put in a volatility that represents, what you're interested, like 7 days or something. And I don't personally look at expected range for, like, let's say I'm in a 30-day trade. I don't look at the expected range for 30 days. Or if we do a lot of short-term strategies, like 15 days out or 7. And I don't look at the expected range for that. I look at the expected range for how long I'm going to be in the trade. And generally on these types of trades that we do, whether it's 7 days, 15 days, 30 days, or 50 days, is a rough guideline. I'm looking to be in the trade on the low end, 15 to 20% of the duration, and the high end, 30% of the duration. So on a 30-day trade, the most I'll probably be in is 9 days. On a 15-day trade, looking to be in it 2 or 3 days. On a 50-day trade, probably looking to be in it 15 days or 2 weeks. So that's kind of how we look at it. So let's jump into strategies here. And let me start with, I'll come back here, move around. Calendars are simpler, but I'll go right to backspread. Let me ask, how many people have done live backspreads, the ratio spreads? How many, has anybody in here done in the last 2 months or so, any back ratios, calls, puts, or any type? And basically it would be, you're buying more calls than you're selling, like in this example, or you're buying more puts than you're selling. Has anybody done any of these?
How many people have done that kind of ratio spread or any kind of ratio spread?
Any kind, puts, calls.
Mark, have you done this?
Just trying to get
Hey,
it.
no, I've not done any back spreads, so can't help you.
Okay, has anyone?
I was just trying to get an idea from experience level. Brian and Doug said yes. Lewis says no. Rick, no. Okay. Haven't. Okay. Now, Gary, yes. Okay, so half in the chat have done them, half haven't. Now, when I traded at the CBOE, I traded at the CBOE from maybe 1982 to 2004. And most of that time, I worked with John and Pete Nigerian, who are both, I think they're still regulars on CNBC Fast Money, Fast, I don't know what it's called, but I think they're on there. But when we were in the pit, believe it or not, back spreads were one of the most popular strategies. Not that we went out to seek to do these strategies, but we ended up in them. Anybody would guess why? Why do you think pit traders did a ton of back spreads? More than they wanted to. Anybody take a...
Probably to meet demand from the retail or from...
That was it. You hit it. I mean, most of the time I was down there, the market was going up, except for some periods where we'd go down very fast. So the popular strategy, what's the most popular strategy with retail people? A lot of them. What would you guess?
Buy and hold.
Well, buy and hold, but if they're going to do options.
Long calls.
Well, long calls, covered writes. There's a lot of covered writers or selling puts. And, as the market goes up, there was always a huge supply of sellers of calls. And so, whereas when the market goes down fast, it's not the supply of short puts that you get on the upside of short calls, right? A little more fear on the downside, and that's why the out-of-the-money puts in the SPX or volatility can get so high. But so the question is, who were the baboons who bought all these calls from the retail people? Who were these guys who bought them? Us, right? Did we buy them because we wanted to? Most of the time, no. We bought them because it was our job, right? Part of the job of a market maker or specialist in the pit was a wholesaler, right? My bid is 2, my ask is 220. I buy them at 2, sell them at 220. What do you want to do? Dan, I'll sell you 100 at $2. So I bought, if I buy 100 at the money calls at whatever the price, I'm making this up, $2, how many deltas do I get long if I buy 100 at the money calls? Take a guess.
10,000.
100 at the money calls, what would be a delta?
Oh, I'm sorry. That's a 50 delta.
Yeah, so 100 times 50, right, would be 5,000, right?
Yep.
So our job in the pit, other than we're volatility traders, but our job was to, ideally we would like to do riskless strategies like, I'll just throw these names out there. It's not that applicable in the retail community, but reversals, conversions, jelly rolls, these were all riskless strategies that you would do to go home with basically no risk. You want, in other words, lock in the money, but you couldn't always do that. So if I were to buy 100 calls at a 50 delta, I'm 5,000 deltas long. What do I do? So immediately I go in and hedge it. How do I hedge it? Most of the time we would hedge it. I'd sell 5,000 shares of stock. So if I did this in IBM, I would buy my 5,000 deltas of calls and sell stock. And so you end up in a smile graph, kind of like this, right? The back spread. And so we got a lot of use doing these strategies, but it wasn't that we woke up in the morning and said, I want to put on a back spread. But that was just something we happened to get into a lot. But over the last 10 years, if you asked me how many live back spreads myself or people in our community did, you know what I would tell you? 5. I mean, very little. We weren't having big moves every day. But when this move started in probably late February, early March, we started doing a lot of these back spreads. Mark Fenton, myself, Mark Fenton kind of spearheaded it, was doing these. We had talked about it a lot, but he was doing them. I started doing them. And this is I'm just giving you an example of how we did it. And we'll probably put maybe 3 to 4 of these on every week, probably for the last couple months. And again, I'll get into a little more on the back spread, but what do you need for these to be successful? And why was this an unusual period that these can work? Here's the answer. Because we were moving 2% every day, right? And what's funny is right before the market hit, right, this corona correction started, or whatever you want to call it, I don't know if any of you remember reading in the Wall Street Journal or just being observing of it, I remember reading an article saying how long it's been since we got any 1% moves in the SPX, right? It had to be, within two weeks of the start of the correction. I remember reading an article, and knowing we weren't getting any 1% moves, right? The market was like non-existent. So with 2% moves on a daily basis, this is a really good strategy. Now, so let me go over this. And this is kind of the version. What we were doing is many different ways to do this. And you could tell me maybe when I'm done, the people who said yes, maybe they can say if they were doing it differently or whatever. So I just took this example on the close today. We closed at 27.97. And an example that we were doing it would be, we generally would be about 7 to 10 days, 7 to 11 days out. Here's the underline. Again, I'm using Thinkorswim. So if you see this green line is the expiration graph, the purple line is today. And we were selling 2 calls. If this is the underlying price, selling 2 calls at the 28.30 strike and buying 3 calls at the 28.80 strike. So basically I'm selling generally a 30 to maybe a 35 delta, maybe a little bit more for the call, and 50 wide. And again, there's different ratios that you can use. These are some of the ratios we would use. This is going to get you more short deltas and a higher credit, believe it or not. This is, 2 to 1 would be a little better situated for the upside, get you a little more long deltas, but this would be pretty typical, 3 to 2. And believe it or not, a call ratio back spread, even though you can see the green line is the expiration graph in 11 days, the purple line is your graph today. And you can see, even though the graph looks like you can make a lot of money on the upside, really the call ratio back spread does best on the downside because you're bringing this big credit, and it's a $17.20 credit. And typically when the market has been going down, this credit will go down pretty quickly, maybe to $10 or $9, and you can buy it back. Now, a couple things on it. The Greeks, generally we would be starting these out 0 to 3 delta short for every 3 to 2. So if you do it 3 to 2, that's doing this once. If you do it 6 by 4, that'd be twice. Again, this is not a beginner spread. I don't know if I should have started with this, but just because the market's been moving, we'll just talk about this and then we'll move on to calendars, which is or credit spread type trades. But this trade, the negative is in a retail account. Well, the negative is if it doesn't move, right? It's negative theta, right? Time decay, you're losing money on time decay. It's positive vega, so as the volatility increases, that's a good benefit. And different ways you could look at this. You could look at this, it's a call ratio back spread. You could look at this as 2 wide call credit spreads and 1 extra long, however you want to look at it, but it's got a hefty credit. Now, here's the good, the bad, and the ugly. The main reason I have not taught these the last 10, 12 years is the margin in a retail account is horrendous, right? $10,000. But with the movement, people have still been, usually we've been trying to make like 6 to 10% on this. So that'd be $600 to $1,000 for every 10,000 in a retail account. Just to give you an example, quite a few of our folk have portfolio margins. This same spread in a portfolio margin account is $2,000, right? So big difference. And the whole idea is, the market goes down, right? And you start getting deep into the wing here. The wing is your short, the 28.30. If it stays down here, you could leave it on, but a lot of times we would just take it off if it goes down. Usually we would try to enter this type of trade on an up day. It could be intraday. But again, big margin. But again, here's the key. If in a portfolio margin account, it is not big margin, right? But in a retail account with the market moving 10%, it was still a great trade, right? We probably had, I bet 100 people easily in the community doing this almost every day or two. And probably winning about 90% of the time. Just because, again, because of the market, not because of, any great smarts or anything. It's just the market was moving 2%, right? And that's what you need. Now, it's funny, I'm talking about these back spreads. Let me ask, do you think yesterday and today were good days for this strategy? What do you think overall? Anybody?
Anybody have an opinion?
It's not a trick question, I promise.
I think Luis is saying pretty good. Mark says probably not.
All right, Mark, why not? I'm looking for something. Steve hit it, right? And again, that's why it's important to keep in mind in this volatile environment, what's the volatility, kind of what's the range, right? We've been between 37 and 55 the last 2-3 weeks. Last Thursday, we hit 37. Last week, Thursday. Then early in the week, Monday and Tuesday, we had a couple down days, right? And we went up about 7 points to 45. So I put some back spreads on Tuesday. Some of them did well, some not. But the key is Wednesday and Thursday, VIX went up, VIX went from 37 to 45 last week, Thursday to Tuesday of this week. And then Wednesday and Thursday of this week, VIX has dropped about 6-7 points. So what don't you want for this trade? You basically don't want two things: volatility to go down, and you don't like this coming up in this area. I call this the Sea of Death, or the Bermuda Triangle. And you say, what is that, Dan? Anywhere near your long option, right? And so, believe it or not, even though the graph says you make a lot of money on the upside, this is best for the downside. Now, I made some money. I put a trade on Tuesday. And Wednesday morning, my 3-to-2 ratio lost money. But I also had on a 2-to-1 that was a little bit more long delta, and that did really well Wednesday morning, just for a little bit, and then the vol started coming down. Anyways, so just wanted to throw this out there. I think it's still good, and I'll just give another thought. It's still good. It's slowing down a little bit, even though we're still getting good movement. You say today didn't move much. Well, we dropped 50, 60 points from the high. So you're still getting movement. I just think you have to be very careful with the VIX levels now when you're putting this on. But the other thing we've been doing is with these back spreads, we've been, as things slow a little bit, we've been putting on some calendars against it at the money, and that's been working well. And you just kind of adapt, right? You adapt to what the market's giving you. So anyways, I hope that didn't completely throw everybody off, but that's a back spread. Any questions on that? And I would like to know, I think there were 3 or 4 people that talked about back spreads. Would one of them or two like to maybe talk about, were they doing something like this or something different?
Okay, Gary, or I think it was AJ, or anybody want to turn on their mic? Or type.
Any questions on this, or does anybody want to share? Lewis says, would you have tried a put version of the trade? I've been doing put versions of this trade. Usually when I've been doing calls and puts, when the market is, when we've gone up for 3, last week I was doing puts, Lewis, when the VIX got near 37, I was doing put back spreads. After 3-4 days up in the market and the VIX is lower, then I do puts. Also would do puts because, again, that's one time I would do puts, Lewis. The other time that I would do puts is if I really thought the market was going to start slowly going up, but I thought there still could be some movement, I do a put ratio because I can do it for a credit, and I wouldn't have this potential sea of death to run into, because this could get ugly for a back spread. So doing backs, I think any strategy that somebody does, you really have to know the weak spot and guard against it so you don't lose much. But these back spreads, you have to, one of the ways we guard against getting hurt is I only stay in back spreads maybe 20% of the duration. So we've been in these back spreads we've been putting on 1-2 days max. All right.
So Dan, I got a question for you. This is Mark Mosley.
Oh, hi, Mark.
Hey, so, I modeled this out on my Thinkorswim while you were talking about it, which is the benefit of this remote setup here. And then so I advance the time forward, and I get a dropping T+0 line unless the stock moves on down. If it was to just hover around where we are, the negative theta would be eating into you fairly quickly. So you really need the stock to move on down in this trade rather than even staying still.
Correct.
So anyway, I just thought I'd throw that out for the benefit of the group.
Well, yeah, and the key is, yeah, absolutely. That's why we haven't been doing it much of the last 10 years. But, if I were to say to you, hey, Mark, how many days has the SPX sat still? You say, what?
That's true. If you could do it, when we're at resistance on the price chart, that might be a good time.
We've been doing them almost every day the last almost 3 months.
Okay.
They've worked well. I mean, because again, the key is this: as long as the volatility stays up, you're getting movements. If you go back and look at the 2% moves, it's been well. I mean, again, we're tweaking this a little bit. We just started adding calendars into it, and we're not going to do it if it doesn't work anymore. But it's still working. But again, you haven't had many days where it just sits there, right? So it's been, again, ideally, it's good when the market's up and then going down. But again, you can make money with it going up. Tuesday evening of this week, I put on a 2-by-1 ratio spread, and it did really well Wednesday morning with the volatility going down. So it's just, as you tweak these things and you get used to them, Mark, and you understand the different ratios and how you want to lean, they can work well. For me, the biggest thing is once the market moves, if we start getting more 1% moves, it's just not as good. But I'm just saying, for the last 3 months, this has been probably the most effective strategy, one of the top 2 or 3 that we've been doing. So I'm not, I just want to.
Cool.
But yeah, there is risk. There's risk with everything, right?
Sure.
There's any trade we do, there's risk. And again, for this environment, this has been good, right? And we're very careful with a negative theta trade. I don't normally do them, but it's been working. Do I think it will be working for the next year? Probably not. But again, how many people out there think with this coronavirus thing that we're not going to be, that we're going to go back to a 15, 16 volatility anytime soon? Does anybody think that? Anybody think that we're going to start moving 0.5% a day? And no, I mean, you're going to, I think things will slow, but there's still going to be pockets. I mean, there's a lot of unknowns here. Agree? At least I would think so.
Yeah, definitely a slow decay back to normal, back to the mean for volatility. That's for sure.
Yeah, and again, you can do this for a smaller account. You could do this in SPY, which is just 10 times smaller. And again, I did a class on this a couple of weeks ago. If you want to learn more about this, the different ratios and the different ways to do this and stuff, you can get some information on our website on that. The main way Lewis is talking about the sea of death. The main way that we deal with the sea of death is a couple different ways. If it's a call back spread like this, we don't stay in it long. We mitigate the sea of death problem by only staying in the trade 20% of the duration. So maybe in this trade, 11 days, 2 days. And the other thing is we go up. Again, there is no problem with the sea of death if you're only going to be in the trade 1 to 2 days. You're not going to have any problem with the sea of death in 1 or 2 days. Do I use any other indicators for the setup entry point? No, I mean, the call back spread, again, I'd rather put it up, again, intraday or any day when the market's more up versus down. But again, I put it even when it's down, I may just do a different ratio. I may do 2 to 1 and lean a little bit delta long. So I'm changing the ratio. Sometimes I'm changing the width of the trade. Sometimes I'm selling a 30 delta. Sometimes I'm selling a 40 delta. John says, sea of death turns into a puddle of pain if it's only 1 or 2 days. No, it doesn't. No, sea of death does not. If you have an 11-day trade, you don't turn into a huge problem the first day or two.
Oh no, I'm sorry. I was just trying to make a joke, right?
Oh, okay.
You're only in for a couple of days. Your green line is at expiration. So it's.
Oh yeah. Your green line is at expiration. The purple line is today. But again, you have to be very concerned and sober, and it's good to, you want to know where your problems come in. And again, we have a max loss also. So for, in a retail account, if you're trying to make $700 to $1,000 per 10,000, you don't want to lose more than, on the worst, 700 to 1,000. But, most people, if it starts going against them, what I've observed in myself, if I'm down 300 or 400 per 10,000, you get out. Anyways, let's move on to the next one. Get more income. That's the only really I would consider spec. Another one, how many people do call credit spreads? How many people do call credit spreads? Or put credit spreads, it doesn't matter. How many people do or historically have done credit spreads? I know Tim has done, I'm trying to remember, what did Tim call it? What did he call that him and Dave came up with? I forget now, but credit spreads.
Yes.
So
Parking trade.
Parking trade. Okay, there we go. So here's the thinking. In this environment, as the market was going crazy back and forth, you could say, well, you could do credit spreads, but how many people were concerned that doing call or put credit spreads, how many felt that it was still too big a delta? That if you were on the wrong side, if you did a call credit spread at resistance or something and you were wrong, you could get your face ripped off. Was anybody a little nervous about doing credit spreads with these whips? My guess is everybody was, but
yes, I would be pretty nervous about that.
Yeah. So this is just a way you can do it on the put side. This is just a way to do it on the call side, to take away a lot of the delta of the call credit spread or put. You can do either way, and make it much more palatable, closer to delta neutral. Something that could be a standalone, or it could be, you could do a ratio call fly near resistance, or when you think it's going down, or you don't think it's going up too much. You could do a put ratio fly when you think the market's going up, or you don't think it's going down too far. And if you think there's more established range, you can do both of them, right? Call one on the call side, a put one on the other side. It kind of looks like I don't know if it's the same type of trades we did in the past, something like a Batman strategy. But you can leg into an iron condor type. But here's the gist of it, at least how I do it. And these have been the basic guidelines. And again, I've mainly been doing this, again, just trying to figure, when you're trading, you're just trying to figure out what works now, right? And this is something I got comfortable with, and some other folks started doing it. So if this is the underlying, and I would put it on a day like, I'd feel comfortable putting it on, for me, in the market now. You say, why? We're kind of in the upper end of the range, at least from if you look at a chart of the SPX, right, over the last few weeks, right? And being in the upper end of the range here, I kind of set it up. It's basically, this call ratio is, and there's different forms you could do this. You can do this 1-4-3. I'm just doing this 1-3-2, which is 2 call credit spreads and 1 debit spread. 2 call credit spreads, 1 debit spread. So take some of the sting out, and you can see you're only 3 deltas, a little over 3 deltas short, which if you did a call credit spread, you're going to be much more than 3 deltas short on a 20 wide. So I'm selling generally about a 25 delta. And again, you can be out 22 days to 30 days. I'm selling a 25 delta. I'm buying my longs 20 points up, and I buy longs 20 points out of the money. Pretty simple. right? 1, 3, 2, 2 call credit spreads, 1 debit spread. You could, if you want to enter it as a fly, you could. I usually I'll do the 2 credit spreads, then 1 debit spread. Either way, whatever you're comfortable with. But again, I'm selling about a 25 delta, and I buy my longs 20 down and 20 up. And generally, I've been getting over the last month or two about a $5 credit, and the margin's 1,500. So the expiration yield starting out is about 33%. And this is the graph, right? So you're taking some of the potential out of the credit spread, but you got a little more balance here, right? It's not, you don't have that sting on the upside as the call credit spread. And you can see you get nice positive theta, short vega. You know, usually the deltas have been in the 3s, and this has worked real well. And even on days where the SPX would be up 100 points with the volatility coming down, these are easy to manage. No adjustments on the downside, nothing. Usually try to make around 10 or 15% on these things, and easy to manage on the upside. Won't get into all the risk management, but on the upside, generally I watch the delta of the short call. So if that 25 delta gets up near 35, I'll look, maybe I'll roll the whole spread out, or I might roll my upper strike long call down from the 29.60 to the 29.55, little tweaks. But these are relatively easy to manage on the upside, and they can handle big moves to the upside, unlike a call credit spread. So these have worked well. I've done them both on the put side and the call side. But anyways, this is another type of trade besides the back spread that we've done a lot of these in our community the last 2.5 months or so. Any questions or comments on this one? And again, what kind of prompted me to kind of use this and work with this is because it just gave me a little better delta, a little more protection than a credit spread. Credit spreads, if you're wrong in this kind of market, you get beat up a little bit more. And so this was just more palatable, can handle bigger moves type thing. All right. Anybody ever done anything like this, or any comments on this?
Who has a comment? Who's done some of these recently or anytime?
Or a version of this, or I think these work well. Yeah, Tim says it's more just a hedge. It's just, I mean, I'm pretty risk averse. I don't like to swing. I'm not good at swinging deltas. Mark Fenton, who works with me, he's got more of a, it seems like, maybe because he's a hunter, he's got more threshold for pain than I do. But it's just a hedge that in this environment, I did some classes on hedged strategy series because I just felt, for me to be comfortable putting trades on in the last 2.5 months, I didn't want to have a lot of swing and delta, or I didn't want to be off short a lot of deltas because this thing was too ferocious. Anyways, this works well. You can do it on the put side. 1, 4, 3 would be 3 credit spreads and 1 debit spread. The problem with 1, 4, 3 is if we go up, you're going to get hurt more than a 1, 3, 2. So anyways, I thought this was very conservative trade, and people have done well with this. All right. So I'll move on here.
I have a quick question, if I may. This is Luis.
Hi.
If I understood correctly, you plan to hold this trade 2 or 3 days, even though it's out to middle of May, right?
No.
No.
No. The ratio, the first trade I talked about, Lewis, was the call ratio back spread, right?
Right.
Remember that one? So that's
right.
The one I talked about 2 or 3 days. This trade, I would be looking to make 10 or 15%. I might be in this trade maybe 4 days or so. So this is a different trade. This is a totally different trade. This is a positive theta income trade, totally different than the one I did before, right?
Right. Okay.
So about 4 days, 4 to 5 days max. So if I'm doing this 22 days, I can turn my inventory over. Generally, I could do one of these a week, as long as I'm around this 20 days and in 20, 22 days, especially with the way the market's been moving.
Okay, so your profit and loss for that 4 day is going to be along that purple line. So if the market went up, let's say the market is up by Wednesday next week, would you fold and take a loss at that point, or you doctor the trade a little longer?
Well, it depends if it goes against me. So if it goes against me, if it goes up, again, remember the one thing the purple line isn't showing is the volatility, right? If you look at Thinkorswim or a brokerage platform, this purple line isn't accounting for volatility going down on the upside, right? So it won't look quite like that. But yeah, on the upside, I would just adjust it, Lewis, probably. I would adjust the short call, kind of what I mentioned, when the delta of the short call goes up from 25, which is normally how I do it, to maybe 35. And I may just, sometimes I'll roll the whole thing out. But most of the time, I've just kind of been waiting till a little bit of resistance or something like that. But on the upside, I just adjust them. So then I would be in maybe more than 3 days or so if it goes up for a while.
Okay.
But again, I try not to put these on unless we've gone up 3 or 4 days. So again, we've been kind of a little bit range bound in the market, especially the last 2 weeks. So if we're down 2-3 days, I'm doing the put ratio fly. If we're up 2-3 days, I'll do the call ratio. But again, I'm not, check my deltas out. I'm not sticking my head out like I am a call credit spread, right? If you do a call credit spread 20 wide, you're not going to be 3 deltas short, right? So, these aren't that problematic on the upside in terms of getting in a lot of trouble, as long as you're disciplined and know where you're going to adjust it and stuff like that. All right. Any other questions or comments or? All right. Let me switch to calendars. Let's see. Dan, how are we doing time-wise? What time did we start? 6:30?
We started, I think at 6:38.
Oh,
But, we have lots of time. We have as long as you want.
Well, I want to, I think I was going to watch a movie with my wife, but I told her maybe like 8 o'clock or so. So
well, no, whenever you want to leave, just leave. That's no problem.
I can go
although we value every minute spent with us, but
no, we'll go till. How about if we go till? We'll go near 8 because we're kind of doing. I don't know if we need to post for question because we're doing. I mean, we're kind of. I think people feel if someone has a question, I'm after each strategy, people are able to ask, or if they want to, anytime they can ask a question. But yeah, we'll just go maybe right up near 8 o'clock. See if I can do a couple
absolutely.
more. Let's see. Calendars have been working well. I know you wouldn't think so in a high volatility environment, but again, we're looking at least now with a VIX range generally around. Let me click this thing. I'm looking at the VIX range right now until things change. About 35 to 50. So I'm looking more in this 35 to 38, 35, kind of around there to do calendars. But again, I'm doing them generally where my shorts are 15 to 21 days out. So I might do the calendars up to maybe a 39 volatility, maybe even 40, because when you start getting 15 to 22 days from expiration, you're picking up a lot of positive theta. And one of the things, the negative about calendars, people always say, well, volatilities go down. Yeah, so you got to be careful with that. But what's one of the advantages people can think of calendars in a very volatile environment that you did? What's the biggest benefit you can see if you look at pluses and minuses of calendars in the current environment? What's a plus? Give me what you guys would consider a plus.
Well, a plus is they benefit from the increasing volatility. So
depending, as long as the volatility doesn't go up too fast, right? If generally if volatility goes up, it's good for a calendar, but not if the volatility goes up too fast. Because if it goes up too fast, like if we have a 4% move tomorrow down in the SPX, will it benefit the calendar? No. Why? Because the volatility of the short will be affected by more than the long, and you really won't make much. Not that you'll get killed with it, but you won't get the benefit. But I'd say most of the time, volatility will help it. But the biggest thing is, like Ed said, this is only a 15 by 22 day calendar, and you're getting almost 90 to 100 points break evens. That's a lot, right? In other words, when I was doing short-term calendars 3 months ago in SPX, you're getting 25 points each way, right? For your break evens. Now you're getting, here's a 15 versus 22 days. So a couple things we do with calendars in this environment. You say, how can you guard against getting hurt by volatility? 3 things. Number 1, keep the distance of your long to your short. We've been doing them 7 days between the long and the short, 14 days between the long and the short. But I did a calendar Tuesday because the volatilities were higher, like 15 versus 19 days or something like that. But generally, we're keeping right now the long distance between the long and the short about 7 days. That helps keep the vega under control. We're getting wide break evens. You're paying more for it. The debit's a little higher than you would pay 3 months ago. Generally, I set them at the money, but these calendars, they're a good income producing strategy. Again, on a $2,800 vehicle like SPX, whether you set it 20 or 30 points up or down, it doesn't matter, right? 20 or 30 points. Whether you start a butterfly 20 or 30 points down or 20, it doesn't really, it's a $2,800 vehicle, right? So it's $17 debit. So we might be looking to make, if you're looking to make 10% on this, 10% on 1,700 is like $170. So if I buy it for 17, I'd look to sell it for an 1870 credit. And then if this is my max loss, 10%, 170, if the spread on the other side goes to 1530 or lower, I'd get out, right? So that's a basic profit target and max loss. Adjustments, when I'm doing 15-day trades, I don't do more than one adjustment. I just think it's useless. You're wrestling with an alligator, usually a 15-day trade will be in about 3 days. I don't want to do 14 adjustments. Right? If it's a longer term trade, we'll do more adjustments, but not in a 15-day trade. I might do one adjustment, either turn it into a double calendar, or I like to maybe reposition it. So if we go down towards the downside break even, I might take off the existing calendar and just plop another one on at the money. And again, I'm going kind of quick here, but, and I'm not sure Don, would you say the level here is more beginner, intermediate, advanced? I know obviously Tim and
well, it's not that. I don't know. That's a tough one. I think we have a mix, but we have a lot of less experienced members. We have a few very experienced members, very experienced members too. Yeah,
and I think the key is this. It's all about practice, right? You can have, somebody who Don might, say, Dan, this guy's tremendously experienced, right? right? He's tremendous. And then you talk to the person and you say, well, what do you do? I've done, 5,000 call credit spreads. Well, I would rephrase that. He's very experienced in credit spreads, right? But if you ask him, have you ever done calendars? No. Have you ever done back spreads? No. Well, then he's not, he's experienced in certain things. You know what I'm saying? So it's like, I think there's a lot of people who might be very experienced, but you have to get, well, what are they experienced? Some people maybe are, are more experienced with certain strategies, where I think a fewer amount of people might be more experienced in 3 or 4 different strategies. And so, like myself, if I do a strategy that I'm not really familiar with, I'm going to do it 1 contract or 2 for a while till I get really comfortable. And anyways, so I think calendars are we've been using these in conjunction with other spreads, like with the back spread, using these in stocks, range bound. We've been using these in trying to find range bound stocks too. But I think calendars have been, again, I like them in the short term. They work well. You get wide ranges. And I like the fact that you can turn over the inventory. You can get one of these on every week. And then one more strategy, we've done a lot of iron condors. Since the market, once we got to 2,200 in the SPX and we kind of leveled off a little bit where it looked like the world wasn't going to end, probably this was as good, as condor opportunities in terms of how wide you can do them. I've never seen them wider. I don't know if any of you have ever traded iron condors. I've never seen, in the years I've been trading, I've never seen wider iron condors. Now, they're not as good today as they were when, a couple of weeks ago or 3 weeks ago when the vol was higher, but they're still very, very good. Here's an example of an iron condor, which is a call and put credit spread. And Tom Nelson says, can you use a calendar at the short strike of the condor in a low vol market? You could. I just wouldn't do iron condors in a low vol market, Tom. I would do double diagonals instead. Double diagonals to me are the cousin of the iron condors. When volatilities are low, I would do double diagonals, which have similar risk profile. But here's an example. I just took this at the close of trading today. Here's a 36-day iron condor in the SPX. And because the market's kind of come up here a bit, there are 2 types of iron condors I look at. An iron condor where the delta of the call and the put are the same, or an iron condor where the put's higher than the call. This particular one I have now is the delta of the call is 12. The delta of the put is 15, right, on this 36 days. So I'm selling the 2,400 puts, buying the 2,390s, selling the 3070 calls, buying the 3080s. So my short call is about, what is that math-wise? 273 points out of the money. And my short put is almost 400 puts out of the money. So on this type of one. And so I want a little more room on the downside. And with these, I'm about a half a delta short, right? So that's less than 1. Delta neutrality to me is anywhere between 2 deltas long and 2 deltas short. And this is less than a delta short. Positive theta, this is 36 days out. But I think these go really, I think these have worked real well. You got a lot of stinking room here, right? And so on a 36-day, I would expect to be in here probably 10 to 12 days. Could you get out in a week? You could. If the VIX, I think the VIX today is what, 41? If the VIX were to drop 4 or 5 points, you probably could get out in a week. But I think these are very good strategies. But again, if this is the VIX range, so over the next 2 weeks, what I would be doing is looking, if I'm looking at this as the range, and right now, where do we close at 41 today? If I guessed right. So I'm putting some on now, but I would be more, I'd get a little more excited in this range, maybe around 45 VIX. That's kind of how I'm looking at it. Any questions on this? Any questions? And then when I'm done with this, I will just do my last strategy and then we'll call it a night. Any questions on iron condors? Anything? Again, obviously we're just touching on these things.
No questions like this.
Has anybody been doing iron condors the last month or 2 weeks? Has anybody been doing iron condors? Yeah, I mean, it's been a nice range. They've worked very well. And I would question, I'd be shocked if anybody put in on iron condors. Has any of you guys lost on any in the last 2 weeks or 3?
We got several people saying yes there.
No, I think they're saying yes to they did iron condors, not to, I don't think.
Right, yes to they did iron condors.
Yeah, I don't think.
No to loss.
Yeah, I don't know how you would lose with, because you're still, when you're getting 40 VIX or higher, you're getting a lot of stinking room here. All right. If there's no questions, we'll go to the last strategy that we've used at times. Let me. All right, last one. Now, a long diagonal is more in the, you can call it a covered right alternative. It's in the long portfolio, the view of an investor. You like Apple over a period of time. Or again, you could say you like Apple over the next month, or you like Apple over, if you like it over the next year or two, you could do this every month, but it's just a covered right without stock, right? If you go in and did a covered right in SPY, you're going to have to buy 100 shares of SPY and it's going to cost you $27,000, right? So what I do is here's just an example of one. And with the way the market is, if we're down for a couple days, I will do these. And part of it is, I just think right now, these are a lot better even than a collar or anything, even if you're nervous about the downside, because depending where you place the short call, you can get a lot of protection on the downside. So here's an example. Again, I'm not going really far out on my longs just because it gets more expensive. You could, but I'm buying a May 29, 36 days out, a 247 call. That's like an 80 delta, like a stock surrogate. And then I'm selling a May 15, 272 call. Now this is probably close to a 60 delta. So it's just giving me a little more downside protection. So my expiration break even, I have some room there. I think in this one, you get about 4.5% downside protection. It's not a ton, but it's something, right? If you want to get more downside protection, instead of a 60 delta, you can sell a 70. But this is normally a long Vega strategy, but because the vols are so high, you can do them for short Vega, right? So as the market goes up, you're a little bit long delta on this trade, but you're short Vega. So as we go up, you're benefiting on the deltas and the Vega. And I would do these when we're down a couple days because, and I would do these in stocks you like, right? If you like Apple, I would do it on down days. And this has been an effective one at times, right? And I was doing these more like maybe when the market was down 20, when the SPX was down 20, 25%. But even now, when we're down for a couple days in stocks you like, I would do these. Why? Because they give you, if this is the current price, they give you your expiration break evens, depending on where you sell your call against it. you can get 4 to 8% downside protection. So again, I like these because I can do them short Vega, and they're normally a long Vega strategy. So anyways.
So Dan,
yeah.
Dan, I got a question about this one.
Yeah, who's this?
This is Mark Mosley.
Oh, hello, Mark.
So could you, for this particular strategy, could you not flip this around so that you had, if you were worried about the downside, could you manipulate these strikes, or maybe do it in the puts and have no risk on the downside rather than no, you know?
Yeah, I mean, you could do just like a covered right for the downside. But again, for me, I do these in the long portfolio. These are in stocks that I like over the next couple of years, right? Or I like over the next 6 months. So I'm purposely, long. But if you don't, if you want to go the other way, let's say you think SPY is going down over the next month. Yeah, you could flip it. You could buy the May 29, instead of buying an 80 delta call, buy an 80 delta put. And instead of selling and then I would sell a 50 or 60 delta put against it, and you would have a covered right for the downside. So absolutely. I mean, we were talking about that type more before the market went down as like a protective hedge for the downside a little bit for your portfolio. But yes, you can do that for the downside also.
And that might give you an additional boost, with the Vega, if in fact we did go farther down, and well, it's showing negative Vega on this trade, but usually those are positive.
Yeah, usually they're positive Vega, but because the vols are so high and I'm selling the in the money, I've been doing these, you get these for short Vega right now, right, which is nice because if the market goes up, you're making more than you think, and they give you some downside. As the vol goes higher, you can sell a 70 delta against because again, when the volatilities were lower, I wouldn't consider selling in the money calls because it just didn't make a lot of sense. But now the premium's really high, and so you're able to get a little bit more downside protection. Yeah, and the reason I don't go longer, I mean, you could go further out on your longs, but I put a new one of these on every month. Some of these I may do multiple per week. That's why I don't go as far out on the long side. And you can go, again, the whole thing about durations, I think, I like to diversify the durations. Sometimes I'll do like iron condors. If I'm going to do, let's say someone's going to do $10,000 of iron condors, I might do $7,000 worth, 70%, 40 days out or 50 days out, and then 30% in 15 days or 10. So I like to diversify the duration because let's face it, short-term duration, you have more price risk. Long-term duration, you have more volatility risk, but it's safe. It's more safer in terms of the immediate move in the market, like a T+0 curve. All right, any other thoughts or comments? I'll just say this, if you're, just a couple suggestions, if you want to learn more and get more, especially if you're a beginner and you want to get more hands-on how to do this, a couple different things you can do. You go to SheridanMentoring.com on the front page. A couple things you'll find. One, a couple of the current class we're doing is we're trading short-term flies and calendars and back spreads. We're doing a 4-week class. Every class we're putting on at least 1 to 2 live trades. So you're able to see, even if you're a beginner, how to do this, right? We're doing it with you step by step with the idea that after 4 weeks, you get a little bit of confidence that, hey, you've been doing it. The other thing, if you want to, if besides the class, we've been doing this special for the last 2-3 months. We have a program called Basic Program. And the first month you can do a trial for $47, and you can come in and get 2 or 3 hours of live, also recorded teaching. And we're doing this on a daily basis. Most of it's live trades that it's really Mark Fenton and myself. We have another mentor, Jay Bailey, but more Mark and myself. And you're able to see this very practical, how we're navigating through the different market conditions. And it'll be nice. You can see like over the next month, how we tweak things. So anyways, and if you have any questions, I'm Dan at SheridanMentoring.com, but I'd encourage you to check out our website. And thanks, Don, for having me.
Yeah, that's fantastic, Dan. I mean, you gave us more than we bargained for with actually a number of strategies that are currently trading. When you say the Sheridan community, we're doing this or we're doing that, do people who've been, let's say, taking a few courses, do they have, what is the Sheridan community? How would you define that?
Well, I mean, the Sheridan community, you might have two types of folk that are in the Sheridan mentoring. We're doing 2-3 hours of teaching for people who are in the Sheridan, that have done mentoring and every day, where we're teaching students, but we're also doing 2 to 3 hours of live teaching. And really it's navigating through the markets. So we're kind of doing it together, right? And we have, also within there, we have 3 trading groups every week that each of us run, live trading groups. And we're, just putting trades on, other people are putting trades on, seeing what they're doing, versus people that aren't in the community but take courses. We have a lot of online courses people can take, or we have some new programs. This basic program, you can come on like a lot of subscription services and pay $47 the first month, and you can pay $100 after that, I think 100 or 125, and you're getting 3 hours a day of live teaching. You're never going to get anything near that on any subscription service. And so it's a great deal, and you can learn the craft. We're trying to, teach you the stuff. So it's, we have 2 types of people who are more kind of, I pictured, Dad, let me give you a horrible analogy of which I'm known for. Like, just because I was talking to somebody the other day at the Greenville Rescue Mission. Well, you have people at a mission that stay overnight, right? And that live there for a while, for whatever reason. Not to compare the Sheridan mentoring community to a mission, but we have quite a few people that stay overnight and that are there every day, month after month, year after year. And we're trading and we're doing this together. And, it's for people trying to make a living doing this. And then on the other hand, you have people that visit the mission, right? Maybe take classes at the mission and come to learn more about it. And they're coming in for maybe classes, right? At missions, you have like Bible classes and stuff. So people would take, like right now, we're teaching this trading short-term flies and calendars in a volatile market. That's a class. Last month, we ran a series of hedge strategy stuff. So generally, people will take a class and get comfortable, see the community, and then if they want to participate more. But one of the things, Dan, we've done over the last 6 months is we have more, like you would say, subscription service. So people can, whereas before you'd have to come in and join the mentoring, and because one-on-one costs more, it'd be a little more expensive. But now people can come in the community and get a ton at what people pay for a subscription service. And here you're getting 2 to 3 hours a day for $125 a month, which people don't normally for a subscription service. You don't get that kind of attention. So I'm not sure how long we'll keep doing it, but I think it's a great value if people want to learn the craft. And it's very transparent. You're seeing our live trades every day, so there's no curveballs. You're seeing it. But the key is you're learning. There's no mystical, proprietary secret duper duper. No, we're doing it, and you're having a lot of people just trying to navigate through the market. It's like a bunch of surfers in the ocean trying to figure out how do we stay on our surfboards a little longer. So it's one path, and it's a reasonably priced one, which a lot of others are not elsewhere. It can be found elsewhere. Yeah.
To take a couple of courses at very, very low cost. It's really unmatched elsewhere. And then if they want, they can take something that's more in the line of a mentoring, but it can be a group mentoring now.
Yeah,
or something.
but I would start with the, you can, again, if someone's just not sure, for $47, you can come in and get a month of teaching, and you would be able to see what you like. And then we have monthly service. You can get it from $125 a month. But again, there's not going to be a subscription service in the United States that's going to give you more hours of teaching for $100, right? For $125. But that's just what we're doing.
I agree.
Smart.
Absolutely
That's what
agree.
we're doing. Which options modeling software does Dan tend to use most? Right now, Rick, I am not, for the last 4 or 5 years, I have not used any modeling software. I just use TOS. And that has been it. I just used the Thinkorswim. We've got a lot of students that use different back testing softwares and stuff. But I've just been using TOS, and yeah, I mean, it's been good. You get used to what you use, right? Everybody, however, whatever you get used to, but that's what I've been using. And Lewis says, what might become of TOS after Schwab acquires it? Here's my thoughts on the whole brokerage thing. I think, it's great that rates are cheap, right? And we'll be thankful for that. But again, let's face it, rates are zero. Do we still have to figure out a way to make money? Yes or no? Yeah, right? Rates are real cheap. But I think once Schwab acquires TD, unfortunately, and I love Thinkorswim, but I think the more you get, it's just going to become more bureaucratic. When Sosnoff and Scott Sheridan were running it, you could call up, get them on the horn. It's just, I think the only negative with the brokerage industry, it's just becoming a couple people, right? I mean, my guess, I could be wrong. I think Tastyworks will sell in a year or two, and then who will be left? You've got Schwab on one side, and who's on the other side? E-Trade, or who bought E-Trade? I mean, there's only going to be a couple standing, and I just think they're going to get, even though rates are cheap, it's just very bureaucratic, right? Anyways, I mean, that's just my 2 cents. It doesn't, there's always TradeStation. I've never really used TradeStation for options. I mean, there's some good people over there. I think it seems like people go to TradeStation if they're really into technicals. Wouldn't that be fair to say? I don't know anybody who goes there for options.
Dan, if you say it's going to become very bureaucratic, what does that mean in practical terms for me?
Practical terms, it means trying to call somebody that has a stinking clue will become more difficult. Trying to get somebody on the horn. I'm fortunate because we have a community. We've been around a while. I have some people at TOS I can call, but it's still very difficult, meaning to get people, if you have a problem, to get people on the phone at TOS. Who do you talk to, right? And also, I just find if you have a problem, that's what I mean. If you have a problem, I think it's much more difficult. And I think a lot of the good people at TOS are going to be leaving soon. That's my guess. Because
better let Dan go. He wanted to go. He's given us a fantastic amount of information and strategy. Everybody's already posted their thanks, but let me say that is my sentiment also. Of course.
Sure.
Thank you very much.
You're welcome.
I know you have to go. Will, unless there's anything else you want to say.
No, that's fine. It's good to see everybody. Thank you, Don. Thank you, good Tom and Tim and the rest of you. We will see you sometime in the future.
We absolutely.
Oh, one last thing. What was I going to tell you? We do have. The only other thing I can think of, usually I'll post 3 to 4 videos on YouTube, Sheridan Mentoring YouTube, free videos on things I'm seeing in the market per week. And we also have Sheridan Mentoring TV. We do 4 or 5 times a week also. Free content just for if you're a beginner or whatever level, keep you engaged in these things, just more content.
And they cover some of these same topics?
Oh, consistently. And what we're looking at in the market. But again, it's free. Generally now, I'm doing a video on YouTube, Sheridan Mentoring, almost every day now. And we also do Sheridan Mentoring TV almost every day of content. So, just for people can get used to these strategies, what we're looking at, and it's just repetition. But here's the biggest thing. I just want to encourage you, do one contract, try something. And even if it's whatever it is, you have to practice this stuff, right? You're not going to get any good at this reading 437 books, or, you can back test this stuff until you're 900 years old, but you need to, once you get some guidelines and stuff, do one contract and do it 15, 20 times. That's the key to becoming a good craftsman, not jack of all trades, master of none, where you go from strategy to strategy. So I would encourage you, if you're just looking at stuff I went over, if you like something that we went over, take one contract, right? And do it 15 times in a row. That's the secret. If you said to me, what is the secret of being a good option trader? It's the same secret of being a good cook or a good pilot. Put in your stinking hours, right? Put in the trade, but do it the right way. It isn't practice makes perfect. It's good practice. And so for us in our community, who are the best back spreaders in the community? Who are the best butterfly traders? In most cases, it's the guys who've done the most, right? No magic. So anyways, I'll leave you on that note. Don, we'll see you later. Take care.
Thank you very much. Good night.
All right. Thanks.
We really appreciate that. Thank you.
Thanks.
Okay, I'm going to stop. We're going to continue informally. Dan has left. We appreciate that. And we got quite a people left here. We'll continue informally. I think I'm going to stop the recording now.